It's meant to be kind of a joke, but I do think there are some people out there that are scared of overbillings because it reduces revenue and it increases liabilities. And I want to say that shouldn't be enough to make you concerned about overbillings. Overbillings happen, and it's beneficial at times to be overbilled because that means you're essentially receiving more money up front for you to be able to spend on completing the project. So what's wrong with that? Yes, you decrease revenue. Yes, you increase a liability, but technically you should have the cash on hand before you start incurring a significant portion of those expenses. So who wouldn't want that scenario? The idea of this lesson is to emphasize that. I've got a list of jobs here, jobs 1 through 5. Positives are underbillings, negatives are overbillings. So we've got a net overbilling of 138,000. We've got a total overbilling on these 3 jobs of $145,000. So there's a $145,000 liability on the books. That's fine. Okay, what really matters is what is your cash and accounts receivable balance, right? Overbillings, as you know, your billings, your gross profit you're recognizing based off of your billings and costs is higher than your expected gross profit. So what that means is you're ahead of the game. You've billed you build up front for something such as mobilization. That's typically where we see a lot of overbillings. You've billed ahead on that, so ideally you're able to collect that. It turns into cash to then start paying off material, labor, subcontractors, etc. So who wouldn't want that? The key there is you should have the cash, and what's next in line to cash is receivable. So when I go to the balance sheet under current assets and I look at cash and I look at accounts receivable, I should see an amount higher or close to your overbilling amount. That overbilling amount better be backed up by a combination of these two. One of them, it's got to be on the books somewhere so I can trace it and say, yeah, it makes sense, you're overbilled. You've got the assets to support it because you technically should have an asset, right? As I just said, that overbilling should be either cash or it's just you just billed it, last few days of the year and you didn't have time to collect it. So there should be something to support it. And here we see that the cash and AR balance is greater than the total overbilling. Now we go into the worst case scenario down below. Our cash is $15,000 and our receivables are $28,000. Well, that's well below the total overbillings. All right, cash and AR together is $43,000. Where is that overbilling? That's when you get into these questions of what happened to that money. If you were overbilled, you collected the cash, where did that go? Did it go to pay off some debt? Did it go to a distribution so you could purchase some personal property? This is not where you want to be. So on top of the negative revenue, you don't look good at all. You have to have something to support that overbilling. This is, I think, a bigger issue than a drop in revenue because of the overbillings. It's what does your cash and receivable balance look like? Is it enough to substantiate that overbilling? Is there something that we can pinpoint and say, yeah, those overbillings, we can see it. They've billed ahead, they've collected the cash, and they're ready to start spending on the completion of the project. I hope all that made sense. If not, please leave a comment below. Thanks again for tuning in. I'll see you in the next lesson.